Global Mantra Outlook 2013, a special series that we bring to you from London, where we profile prominent fund managers from the city and get their views on the global market situation. Joining me on the show today is Chris Palmer, Director of Emerging Market Equities at Henderson Global Investors. Chris, it's very good to have you on the show.
Thank you.
How do you expect markets to pan out in 2013?
I think Europe was a headwind, but now those headwinds are receding, and investors getting a better taste of what they can expect from emerging markets. I don't think that changes much in 2013. I would expect investors are going to focus on growth, which should be getting better at the margins, despite those headwinds from a slower Europe, and also focusing on corporate profits, which should be recovering as input prices have dropped in the last few quarters.
So do you think inflation would be less of a concern in 2013 for emerging markets than 2012?
Monetary policies in themselves don't appear to have generated much inflation, particularly in the West, where there's, if anything, still dangers of deflation. So our outlook for core global inflation is quite benign. I think one needs to make sure that monetary easing doesn't go too far. But so far there's been very few signs of that. What's the inflation that emerging market policymakers are most concerned about? Now, some of them are interested in the currency wars, that is, appreciation of their currency. I think that some tough choices need to be made by governments and central banks, such as decisions made by Brazil in the past to tax inflows. But I think what's more important, particularly in Asia, but in other markets, is the outlook for general inflation, household inflation, food and energy prices. And there we probably see emerging markets getting a big break in 2013 from some of the more dire forecasts we had of a few years ago. So I think that at that core level of inflation, not monetary inflation, but really demand-led inflation from all those households in the emerging markets, food, energy, and perhaps even wages, we could see some leveling off in 2013.
Which markets are you betting on for 2013?
Well, one market that we think should have a better 2013 is China. Now, a lot of that is already happening. China has been rallying into this transition of the government, where we expect that there will be more efforts to stimulate demand, particularly through infrastructure spending and more focused housing policies, which can get demand going nationally. We've already gotten a sense of what's going to happen before the government transition, and we think that will accelerate into the end of this year and into 2013. Another market which has done actually quite poorly this year in relationship to other emerging markets is Brazil. And we think that Brazil could enjoy a good 2013 after what's been a pretty dismal 2012, because of very low interest rates in Brazil. The government has been reducing interest rates where it can, in other words, by legislation, and mandating lower interest rates for consumers, which we think will have a very positive impact on Brazilian consumption. But also the central bank has been cutting interest rates very sharply over the last year. In fact, those interest rates have been halved, more or less, over the last year. Now, that is going to feed through to much stronger economic growth for Brazil. It cuts the government's bill on its own financing, but it's going to put a lot more money into the hands of the public.
China hasn't done well as a market. Why is that, you think? And a lot of funds are still very overweight on the region.
Yeah, I think that China's underperformed because this idea of a slower growth in China has been a bit of a disappointment to investors, particularly those investors who are expecting some sectors, such as property, to continue to enjoy very high rates of growth. And as those growth rates have dropped off, I think investors, with perfect 20/20 hindsight, might have realized that they overpaid for those assets a few years ago, had they known that the growth rate was going to be declining. But I think the transition into that new phase of slightly lower growth in China, particularly for, let's say, some of the sunset industries in China, I think has been adequately reflected in prices. But there are some great new industries coming through in China that I think can take more of a leadership role going forward and captivate investors once again.
What, to your mind, are the key risks for emerging markets in 2013?
Well, I think the key risks in 2013 are going to be more of the kind of risks that we saw in 2012. In other words, some of those countries slipping off the fiscal path, and that kind of activity is going to involve the fire brigade to come out of the Troika and Washington and everyone to try and put those countries back on the pathway. We think they knew who they are, and some of the Club Med countries come to mind and things like that, but there could be other surprises. I think Middle East policy always holds, the Middle East and policies and how to deal with some of the challenges in the Middle East always will also play a wild card role for investors thinking about risk or what might go wrong. But overall, I think that those risks appear now to be perhaps lower than they were a year ago. Even those fiscal rogues out there who want to go off the rails, I think the likelihood of that is a lot lower now. And what's more important is there appears to be more of a consensus about making sure it doesn't drag on for too long.
What is the expectation on crude, given, you know, the alternative interest that's coming up with shale gas?
Well, the crude oil price is probably underpinned by some demand function out there that's got to do with the fact it's liquid fuel, and liquid fuel demand continues to rise. So I'm not expecting too much more weakness in crude, but we do know at the margins that shale gas is playing a more important role, particularly in the United States. Now, that hasn't happened in any other countries yet to the same extent, but it could start to play a more important role.
But a lot of emerging market countries are actually buying shale gas assets in the U.S.
Yeah, I think what's happening with shale gas assets, and we've seen Indian, Mexican, Chinese companies, it's actually a pretty broad group of companies have gone to the U.S. to learn about shale gas. And this is one of the things that's very interesting about the shale gas industry, is that nobody's really hiding any of the secrets. You know, one is able to go to the U.S., learn about shale gas, partner with U.S. companies, and hopefully we'll see over the next decade those techniques and that knowledge imported back to countries where they feel that they've got a shale gas asset. Now, you need to have the asset, not just the knowledge, but there are other shale gas fields in the world that can be exploited, and we think that's probably a likely area for countries like India and China, who tend to import quite a lot of liquid fuels and oil. They'll be looking at shale gas as another area to supply their own energy needs.
Do you think you're more optimistic as a fund manager about 2013 as a year than you were perhaps stepping into 2012?
I think the way the markets work these days, you've got to be ready for surprises. Okay, and but your strategy can't be dominated by thinking, well, there's a surprise out there, so I'm not going to invest in growth. I'm going to stay very defensive. Defensive investors have done relatively well in the last couple of years, but I think that some of those defensive sectors have become very expensive. And the problem is if you're thinking about growth, you've got to move away from those defensive sectors and take a bit more risk. I think after an okay year like 2012, where investors got a return, I think they'll be thinking about taking more risk in 2013 and abandoning some of those defensive strategies, and just moving a bit more into a more balanced portfolio that includes a bit of energy.
And a lot of financials? Yeah,
and includes financials as well. A surprise factor, for example, in Asia's performance this year is how strongly financials have bounced back.
Let's talk about India in 2013. Your exposure to India is just 5%. India is not really your top 5 markets when it comes to your overall allocations. Why is that, and what will make you change that stance?
Well, very specifically, in some of the companies and the sectors that we look at in India, we just haven't seen the same types of returns and the same positioning from Indian companies that we've seen from competing companies in other countries. We do have some companies in India which we think are competitive and are interested in continuing with our investment there. And they do meet both the local markets demands and international markets demands quite well. So we do find companies to invest in India. But we have seen, certain sectors such as telecom or infrastructure where the returns for investors when you look at the actual corporate profits, have been disappointing.
But financials have done well. Consumer stocks, like you pointed out, are trading at expensive valuations and have still given very good returns for investors. So where is it that you're kind of, investing and making money in the Indian market?
Well, we like the automobile sector, and we like at this early stage in the cycle. We also like industrial companies, for example, in heavy goods and light commercial vehicles, for example. This would be the kind of place where to invest, where if local Indian business people were beginning to feel a bit more positive about the business cycle and positive about growth, where we'd expect demand to be picking up quite rapidly from here. We've had fairly depressed numbers from the industrial sector, from capital goods. And we'd like to see a bounce there. And we actually have identified some companies in that sector that are of interest. We've also seen Indian companies benefiting from the weaker currency. And although not popular with domestic investors, for certain companies in India, the weaker currency, has helped their international competitiveness.
So in autos, which are the stocks that you like? I mean, Tata Motors has done extremely well for this year. From the commercial vehicle space, Ashok Leyland has been a stock that's been spoken about. What are the themes or the specific names that you like?
Well, those are two stocks that we think are very well positioned in India to perform, both for the similar reason that they're focused on the Indian market and abroad. They built some flexibility into their business models that allow them to benefit from the demand growth in India. And in Tata Motors' case, they still hold out great hopes for the Indian domestic automobile industry, heavy goods vehicles, and a number of other products that should grow as India develops and its road system develops, which of course is also necessary. They've also had a spectacular success in the Jaguar Land Rover business, which we still see moving from strength to strength. They've only recently positioned the brand in China, and the early indications are that the brand is positioned right at the top in terms of luxury goods in China, above BMW, even above Mercedes-Benz. This is a special area in China and could reap very big rewards. Also, by renovating the two-seater models for Jaguar, I think this could provide a very, very important engine for growth globally and could be a good reintroduction into many markets where Jaguar has been struggling in recent years, like the United States, for example. So they've got some great ideas there for how to tap the foreign market and how to grow that business. So that's been a very successful continue. At Ashok, it's a much simpler story. The devaluation, in a way, kind of has reset India. And the reality is that a more modestly priced vehicle, particularly for the entry-level business buyer for commercial vehicles, probably makes more sense. And this is a particular area that the company continues to target. They're not going into automobile. They're not going into very expensive heavy goods vehicles. And this is a market overlooked by foreigners, overlooked by many other market participants, in which they are still strong. And we know that there still is a very, very big demand for ultra-low-priced, competitive, and durable vehicles in the commercial segment in India.
In your overall emerging market portfolio, you're very bullish on financials. Consumers is not your top theme, but is ranked in the middle somewhere. Are you bullish about these two sectors in India as well? Because these come at a price.
I think financials in India is very interesting due to the fact that ultimately financials in India that seem to be successful are linked back to the consumer and household demand. Demand for mortgages and for personal consumer financial services remain very high, and the demand has been robust. So those are areas where we see more activity going forward and be of particular interest. They were also the focus of some of the reforms with regards to the insurance industry and foreign ownership limits. So that is an area which could do very well in the future. because of rising household incomes, but more financial planning in India, and also nuclear families, so to speak, in India, which is a big theme.
Right,
those
so
people also need to plan for their future.
Sure, but there's a dichotomy within the Indian banking space. You have the private sector banks, you have the public sector banks. Where are you more drawn to?
Yeah, we do see value emerging in PSU banks. I think that there have been some major differences between what those banks have done in the past and what private banks have done. They have differed. Private banks have essentially cherry-picked the very best businesses in India, people with steady jobs who have payrolls, where it's easier to make them a mortgage and provide some financial services. But let's face it, India is full of very bright people, and I'm sure none of those tricks are lost on the managers of the state-owned banks either. And they will be very eager to try to exploit some of those strategies as well. I think in terms of reform in India, one of the things that has to happen in a balanced way is that the managers of the state-owned banks need to be given a mandate that they both fulfill some social commitment and at the same time explore those new business models from a profitability standpoint and a better value proposition for their key shareholders. The government's a key shareholder, but those banks have other investors as well, and they should be exploring those business models more aggressively. That could be the big surprise in India, is that some of these sleeping giants in India in the state financial services sector are able to transform themselves more rapidly.
What about value merging in cap goods and industrials that you are focusing on right now? Because a lot of the people that we speak to say that that value will only come by once the investment cycle turns.
Well, typically in cap goods and industrials, you've got to get in well before the economy picks up and well before you get those definite signs. India's business cycle should be improving now. The currency realignment itself should have repositioned many industries in India to be more competitive. We think we're beginning to see some signs, for example, in light commercial vehicles, for example, and that's really your deepest level of entrepreneur, right? That's a family-owned company, perhaps adding one or two vehicles to their supply of vehicles. We are beginning to see signs of life there, which is a good sign. I think in terms of trying to gauge what's going on in the business cycle in India, you've got to look quite at the grassroots level for signs of change. The big companies and the big ticket orders, I think that will come later. But I think the person on the street who's investing for their own business, I think we've begun to see some signs that that's picking up.
And that would be purely noises coming in from Delhi ahead of elections. Do you think that the market is also being a bit skeptical on what the government can actually deliver?
Well, I think the market, I'm sorry to say this, but the market's going to trade on what the politicians promise for the future. And I think that that's what's going to be interesting is where do the divisions lie in India and what do the opposing sides promise for investors going forward. I think that could be a surprise factor in the outlook for India and how the markets react, simply because is it going to be a contest of who promises the most? And in that case, people could get quite excited.
How do you draw, Chris, the balance between growth versus valuation, especially when you're picking stocks in India? We know that the consumer discretionary stocks are trading at a high price. They are delivering in terms of the growth numbers. Corporate earnings have been good. But on the other hand, there are a lot of sectors which may be cheaper, even though the earnings visibility is not that clear.
Well, first of all, I think to talk about valuations, one area where we've seen very high valuations is in consumer staples.
The likes of an ITC or an HUL, Dabur, etc.
Yeah, and that extends globally. It's not just a phenomenon in India. This is really something which has impacted emerging markets globally, where consumer durables, household products, healthcare, beauty, these areas have been really bid up by fund managers in the last few years and re-rated ever and ever higher as managers have sought a refuge from the European debt crisis, from volatility, and a number of things. But there's a limit to what can be paid for a company. And what we're seeing now, in fact, is that many of these companies are trading at higher multiples than what would their private transfer value. In other words, when you look at benchmarks around the world and you say, what would a major international company pay for entry into that market? Many of these companies are trading at substantial or near to substantial premiums, or at the same price as what a takeover would occur. So I don't know how much more upside people are going to get from those kind of investments, particularly at a time where emerging markets seem to be going back up again. So the growth is coming from somewhere. The other thing we just point out about that safety trade, as we call it, is that it has been a re-rating. The earnings haven't actually gone up all that much in the last few years. So I think it's a good time for investors to look either inside their own portfolios or at their advisors' portfolios and say, well, tell me about these stocks that are on 30 or 40 times earnings. How much growth are you expecting? And how much growth have these companies recently delivered? So that stability alone is not a justification for holding a stock really forever. The other thing I'd like to point out, and we've learned this in so many industries over time, is that nothing is truly safe, right? One needs to remain flexible and understand that business models can change, but also industries we formerly thought were very safe have turned out to be fraught with problems, like telecommunications, like electric utilities. Things like that actually have turned out to be a lot more volatile than investors thought. And so that's how we approach it. We would look at the targeted upside to a stock and try to determine, hey, can we really honestly expect to make any more money in this name, even having made a model financial forecast?
Do you think that after the returns and the rally that we've seen in consumer stocks, that it's time to book profits?
I think investors should be taking some money off the table in this area. Clearly, there are other industries they can rotate into, and some of those industries do have more volatility in their news flow and perhaps a bit more volatility in their earnings.
You're talking about the industrials, the PSU banks, the like.
Yeah, energy, financials, industrials. But that's now reflected in their multiples. You can buy a bank in India, as you know, for very low multiples and get a dividend. So how much riskier is that investment than one that, let's say, is on 40 times earnings and pays no dividend? We find that the market usually gets this right. And if you look at what's on the move now in India and other emerging markets, we're beginning to see better performance from these so-called cyclical sectors.
Well, thanks very much, Chris, for joining us and giving us your perspective on emerging markets and also your view on India for 2013. With that, we come to the end of this edition of Global Mantra Outlook 2013. Catch you with another guest next week.